Hi, it's Mr. G, and now we're going to be going through 3.2, Analyzing Changes Financial Position, the Equation Analysis Sheet. And so when we're looking at the Equation Analysis Sheet, and I often refer to this with students, this is more of a stepping stone on the way to learning journal entries. A lot of places when they teach it, they'll just go right past this. But it is a good stepping stone when students are trying to learn accounting to just understand, how it works in each individual transaction. Jumping to journal entries, sometimes you do lose some things that way. So it's a great visual way. It's a great way of just seeing exactly how things are affected. But of course, eventually it will be replaced with journal entries. So we're just going to be talking about the equation analysis sheet. So as these transactions occur, which we covered in 3.1, there's changes in the values of assets, liabilities, and capital. They're always changing. If you do a balance sheet, you're doing it at a specific point in time. It's like taking a picture, what was happening at that one moment in time. But beyond that, things have changed, and so that's how it is with businesses. It's always changing. Although the balance sheet shows the value of these assets, liabilities, and capital on a particular date, it is not adequate to reflect changes created by individual transactions. So here we have a balance sheet, okay? And if we look at the essentially the balance sheet, what do we do with an equation analysis? Well, the first thing you want to do is you want to take all the accounts and you want to put all the account names up here. Okay, so take all the accounts, put all the account names up at the top. So that's really what you want to start off with. And then you set up the beginning balances. And the beginning balances are just literally brought in from the opening balances, what you have on your balance sheet. Okay, and that's the starting point where you're starting from. So it's basically saying, here's the snapshot as of January 31st, 2008, and this is what we need to do. And if you notice, the fundamental accounting equation holds true. Assets are equal to liabilities plus owner's equity. It balances, okay? So that's essentially what you have happen in this case, all right? And so if we look at this, we see Metropolitan Movers pays $1,200 cash to Mercury Finance. So think about it for a moment. If you look at it, what accounts are being affected? Well, we know if we're paying cash, cash is going down. So it's minus $1,200 to cash. If we look at Mercury Finance, it's minus $1,200 to there because we're paying off the amount we owe them, our portion of the amount we owe them. And you can see the new balances put below, okay? And so that's essentially what we're doing. If you look at the transaction, it has to balance, even the individual transaction. So assets are equal to liabilities plus owner's equity. We have minus $1,200 for assets is equal to, well, liabilities are minus $1,200 and plus zero, okay? So minus $1,200 equal minus $1,200. We know it holds true because it balances. Okay, and you can also do it with these numbers, and it should balance as well. And so that's one thing for every single line. Every single line has to balance, which means you need at least two changes on every single line in order to get it to balance. Okay, so let's have a look at the next one. Kay Lincoln, who owns Metropolitan Movers, pays $2,500, pays $1,100 in partial payment. So if you look at this, we reduce the amount Kay Lincoln owns by $1,100, and we add it to cash. He paid us $1,100 in cash, and that balances. Now, what you notice with this, if you use the fundamental accounting equation, we have to figure out total assets. Well, it's $1,000 minus, $1,100 minus $1,100 is zero. Well, we know there's no change to liabilities, no change to owner's equity. Zero is equal to zero. That still holds true. So you don't have to have a change on each side of the equation. You can have them on both sides of the equation as long as it equals out in the end. And if we do the totals, we see that those equal out as well. And I do recommend doing the totals once in a while, checking those, because if you made a mistake, you'll be able to figure it out as you're going through. Okay, equipment costing $1,950 is purchased for cash. Well, we know we're paying cash. Cash is going down, and we're buying equipment, so equipment's going up. So once again, $1,950 minus $1,950 is zero. It still balances out. Okay. A new pickup truck is purchased at a cost of $18,000. So here we have three different things. We pay in cash, so cash is going to be going down. We have a truck, which is going to be $18,000, okay? And if we look at it, we have $18,000 minus $10,000. We're left with $8,000. Well, that's on the liability side. 8,000 is equal to 8,000. It still holds true. It balances. Remember, you need a minimum of 2 transactions or 2 accounts you're editing for every single transaction, but there's no maximum. You can have 3, 4, 5, 6, 7. Doesn't matter as long as it balances, okay? But there is a minimum. And you can see they all balance again. Now, Metro Movers completes a storage service for BCAVA at a price of $1,500. A bill is sent to BCAVA. So in this case, our accounts receivable is going up. And now owner's equity is going up. And this is sometimes confusing for people. So when we're talking about owner's equity, what it actually does is it increases your net worth. If you go out and you wash someone's car for $20, what happens? Well, they pay you cash $20 and your net worth has gone up $20. Well, what happens if you have to buy some sponges or something to wash that car? Well, maybe they're $5. So the $5 comes out of your cash, but it also lowers your overall net worth because, you had to buy these sponges and they're not long-term. They're not an asset. They're maybe just using up in that one time that you're car washing, whatever it is. And so essentially they don't have a future value, so you've lost them, okay? So that's essentially what capital is. And so there's 4 different scenarios that would affect capital. When you earn money, you sell something, you do a service for someone. When you have an expense, something that's not an asset that has a future value, that's an expense, that reduces your net worth. Another one is when the owner withdraws money from the company, so drawings or for sole proprietorship. And the other one is going to be then capital. Capital is when the owner invests money in the company. And we'll talk about this in a later section. But just to remember, those are the 4 different scenarios for things that will always go under capital. And you can see everything balances out again. Now, the owner withdraws $500 for personal use, and I just talked about that, owner withdrawing. Well, that's going to affect capital. And so we can see it affects capital and it affects cash because that's what he's taking out of the business. And it still balances out. One of the trucks requires engine work costing $75. The repair is paid in cash when the truck is picked up. A lot of people want to add this to truck because they see truck under assets and they're like, well, there. But if you do an oil change on a truck, it's not increasing the value of the truck. It's not be like, okay, because it did an oil change, this truck is worth $75 more. No, it's just keeping the same value. And so what you want to do is it's what we call an expense, and it would be affecting capital. So in this case, cash is going down by $75, and equity is also going down by $75. It's like in my example, when you buy sponges, it's actually bringing it down. Okay, and everything balances out. And then when you want to go ahead and create a new balance sheet, you take all these new balances and you just put the new ones in, and you've created a new snapshot of what things basically look like. So summary of steps in analyzing a transaction. First, you identify all the items, assets, liabilities, and change them. And you have to carefully look at each transaction, figure out what item is being affected, if it's increasing or decreasing, if it's an asset or liability. See if owner's equity has changed. Remember the accounting equation. If assets decrease and liabilities are unchanged, the equation must be balanced by a decrease in owner's equity. So remember, if it's not an asset or liability, chances are it's going to be an owner's equity. And we went through the 4 different ways owner's equity would be affected. Make certain you at least have 2 of the individual item accounts have changed, but there's no maximum on it. Make sure the equation is always in balance. Do this. Otherwise, you can make a mistake early on and not catch it till the end, till you do your new balance. So just make sure with every transaction it balances. Okay. So that is 3.2. That's equation analysis. So that's essentially how you do that. And it's kind of prepping you to move forward and go into like journal entries. All right. So this is 3.2. I'm Mr. G, and bye for now.